In today's world, your entire investment portfolio is right there, just a tap away on your phone. And that feels like you're in control, right? Like you're being a smart, informed investor. But what if I told you that constant access, that little habit, is the very thing quietly wrecking your financial future? We're going to break down how this seemingly innocent habit could be costing you a fortune.
So let's be honest for a second. How many times a day do you actually open up your brokerage app? Once? 5 times? Maybe more than you'd like to admit? You see that flash of green and you get that little rush of, yeah, I'm a genius. But then you see red and bam, that knot instantly forms in your stomach. And that cycle, that up and down, might feel totally normal, but believe me, it is incredibly dangerous for your long-term wealth.
Because here's the thing, that little habit, it's not just a habit. It is a direct pipeline into the most primitive, most irrational parts of your brain. It's flipping switches on deep-seated biases that can cost you real, hard-earned money. So today, we're going to uncover the psychology behind it, and, this is the important part, we're going to show you exactly how to fight back.
All right, first things first, we need to get one thing straight. The problem isn't the market, it's not the stocks. The problem is right here, in our own minds. The daily, chaotic swings of the market are just a terrible, terrible match for human psychology.
It really all starts with this powerful glitch in our thinking called loss aversion. Behavioral finance nerds have actually studied and quantified this, and what they found is wild. The psychological pain you feel from losing, say, $100 is about twice as intense as the pleasure you get from gaining that exact same $100.
And this chart just lays it out perfectly. Look at that imbalance, that asymmetry. The pain of a loss feels literally twice as bad as the pleasure from a gain feels good. So every single time you check your portfolio, you are choosing to play this loaded emotional game. And since markets go up and down every day, you're constantly exposing yourself to these painful little jolts, which just dramatically increases the odds that you're going to do something dumb, something emotional.
Oh, and loss aversion? It rarely shows up to the party alone. No, daily monitoring triggers this whole cascade of destructive biases. You've got anchoring. That's when you get totally fixated on a price you saw yesterday or last week, so you can't even see the company for what it is today. And then, of course, there's good old FOMO, the fear of missing out, which pushes you to pile in and buy something right at the top of a bubble. As you can see, each of these has a way out, a counter strategy, and we're going to build on that.
Okay, so all this psychological pressure, it isn't just theory. It's not just in your head. It has a real, tangible financial cost. Let's actually look at the hard numbers.
So let's take a look at a tough year, 2022. The S&P 500, the broad market index, finished down about 18%. Now that's our baseline. That's the return you would have gotten if you just bought an index fund and did absolutely nothing.
But what about the average investor? Well, they did way worse. They lost over 21%. So what gives? Why is there a gap? I mean, they were invested in the exact same market, right? That 3% difference, that's what's known as the investor returns gap. And you know what that really is? It is the quantifiable price of panic. Think about that for a second. On a $100,000 portfolio, that's over $3,000 that just, poof, vanished in a single year. Not because the market took it, but because of our own reactions to the market. That's the real cost of checking your phone too often. And this all just boils down to one of the most classic pieces of financial wisdom there is, and it's backed up by decades of data. People who try to time the market, jumping in and out based on the daily news and their gut feelings, they consistently, and I mean consistently, do worse than people who simply invest and stay invested for the long haul. The evidence is just overwhelming. Time in the market always beats timing the market, period.
Okay, so this all sounds pretty bad. How do we fix it? Well, the solution isn't some hot stock tip or a secret algorithm. It's a fundamental shift in your entire mindset. It's about finally learning to separate the signal from the noise.
The legendary investor Benjamin Graham gave us the perfect way to think about this. He said to imagine the stock market as your business partner, and his name is Mr. Market. Now, Mr. Market is, well, he's manic depressive. Some days he shows up euphoric, offering to buy your shares from you at ridiculously high prices. Then other days, he's in a total panic, offering to sell you his shares for pennies on the dollar. Your job isn't to get swept up in his daily mood swings. It's to ignore him, or, even better, to take advantage of his craziness.
And this chart shows why that mindset is so critical. This is what really matters. Over a 70-year period, a staggering 90% of the stock market's returns came from the actual performance of the businesses underneath, their earnings, their dividends. That right there, that is the signal. Less than 10% came from all the speculative nonsense, Mr. Market's mood swings. That's the noise. So when you're checking prices every day, you are obsessing over the 10% that barely matters and completely ignoring the 90% that actually builds wealth.
So let's get practical. Let's turn all this insight into action. To beat our own worst instincts, we don't need more willpower. We need a system. A clear, rule-based protocol that replaces those emotional reactions with disciplined, automatic actions.
And the cornerstone of this whole system is something called dollar cost averaging, or DCA. It's so simple, but it is so incredibly powerful. All you do is invest a fixed amount of money at a fixed interval, like, say, $200 every other Friday, no matter what the market is doing. That's it. This one strategy automates good behavior, it completely removes the stress of trying to time things, and it actually forces you to buy more shares when prices are low, which is exactly what you want to do.
Now, let's put it all together into a full protocol. This is your new game plan. Just look at the frequencies here. See the one for price checking? It says never, or, almost never. Your focus completely shifts. You put your investing on autopilot with DCA, you review the actual business fundamentals maybe once a year, and you rebalance your portfolio based on strict rules, not on fear. This whole thing is about replacing chaotic, reactive behavior with a calm, methodical, and productive process.
So the next time you feel that urge, that itch to pull out your phone and check your portfolio, just stop for a second and ask yourself this one question. Are you about to react to the meaningless, daily noise, or are you focused on the long-term signal? The signal of building real wealth by owning pieces of great businesses. The choice really is yours.